What's up, guys? Welcome to another Masterclass series. I'm really excited because today has already been crazy. It's 9 o'clock here on the West Coast, and the Dow was down 1,000 points. It's come back up a little bit. We got the coronavirus. Rates are going crazy. And I got my good friend on the show, Barry, to help us make sense for all the realtors, consumers, and lenders watching. So before we get going, I got to give you a shout out, man. Two-time winner of the Crystal Ball Award from Zillow and Pulseconomics, which if you guys don't know, this is how they figure it out. They survey 100 of the nation's top economists, investment strategists, housing market analysis, and they look at all of them and they look at the accuracy of their predictions, and they picked the number one person who was the most accurate, and that was our good friend Barry. So good job, man. Two-time winner. Congratulations.
Thank you, man. Thank you.
Super cool. So I want to get right into it because this morning's already been crazy. And if every originator that's watching could ask you one question, I think it would be this. Barry, I got, tens of millions of loans and clients that I'm either locking or floating, and I don't know what to do. It's so crazy. I want to make sure they get the best rate. If Barry Habib was doing Barry Habib's loan, would you lock or would you float this morning?
So this morning I'm floating for sure, as we have been for the month. We've been floating the entire month of February, and I think we've issued one rate lock alert in 2 months. So we've really enjoyed this ride. And as you know, we've been talking about this happening for a long time. And right now, coronavirus is the word du jour. It's a big catalyst, but it is not the reason that this is happening. And that's what people need to understand, because everybody say, oh, it's because of coronavirus. It's not true. Here's the facts, is that back in September, October, before anybody ever heard the name coronavirus, the 10-year Treasury was already down at 1.4%. And we had called that. We said it's going to go lower than that. Yes, many, many times. But the coronavirus just got us there faster. That's all. So what's the coronavirus done to yields? It's represented about a 20, 25 basis point drop. Yes, but this would have happened anyway. So it just accelerated the process. Where do we go from here is the big question, is from locking or floating. And I'm so proud of the way that we've navigated this and called this market both on the real estate side and on the interest rate side. But it's going lower. Yields, now remember, never in a straight line, right? I say this all the time. It doesn't happen in a straight line, but yields are going lower because there are a host of things fundamentally that are still in place. And you're going to see an outbreak in the United States. There may be one already. And what's very, very interesting about the coronavirus is this. Imagine, first of all, when it becomes public that there is an outbreak in the US, and that's inevitable. It has to happen. Yep. And when that does occur, imagine people ask themselves, do I have to go to that movie? Do I have to go out to dinner and risk somebody in the kitchen sneezing on my food? Do I have to maybe even send my kid to school? And so many other things that you can imagine. Do you know that in different parts of the world, they are already saying that we will restrict gatherings of 1,000 people or more? So that means, do we not longer have basketball games that have attendance? A baseball game, we're about to start baseball season. And this is something that is going to be on the minds of people. So if we think that if this is over for the stock market or over for the bond market, please think again. Remember, on CNBC paraded all these idiots that were on there every day telling you buy stocks, buy stocks, buy stocks. Right. All of our subscribers know this, Ryan. You know this. I went on every single day while the stock market was rising saying, I do not believe it. I don't believe that the stock market's right. I think the stock market's wrong. I just got a call from Ivy Zellman 2 minutes before our call. Is the number one housing analyst in the world. I did a call for all of her top fund managers, and they're all like saying, oh my God, everybody else was wrong. How did you get it right? I want to tell you something else that's breaking information that I got. My doctor's Mike Rosen. He's also Oprah Winfrey's doctor. I've talked about him in the past as far as longevity and this and that. But he believes that this virus was engineered in Iran in a lab. And he doesn't believe that this came out of some bat soup in China. So he thinks that this is one of the reasons why they shut down the country in Iran, and that this thing is out. It's going to be a very, very difficult virus to corral and vaccinate for. I mean, let's face it. How long has the flu been around? How long has the common cold been around?
Right.
We still don't have a cure for it, right? Right.
This is crazy. Yeah.
So the pandemic flu was 1918, over 100 years ago. It's 102 years later. We still haven't figured out a cure for it. Okay, so and even this because I get a vaccine for the flu, but it's not a guarantee, right? So what I'm saying to you is this: we're going to find outbreaks in the US. And when we do, what I want you to think about is, why haven't we found them out now? Because you can't test for it.
Right.
There is no testing mechanism yet in the US. The CDC sent out some kits. They were wrong. They are beginning to send out kits. It is my conviction that as the more kits go out and people get properly tested, we will discover cases. That's going to set the media ablaze. You're going to see the stock market probably have a struggle with that. You're going to see a bit of a slowdown in addition to what you're seeing. And you're going to see interest rates decline even further. Now, I want to mention to you, Rob, because we talked about this, I rattled off a few things here. We said the coronavirus has accelerated, but before the coronavirus, what did you have? You had world trade. We get this information from the Dutch. It's like very, very good. And that was pointing to recession. You had low inflation, which the Fed can increase inflation. You have the Cass Freight Index in recession, manufacturing in recession, excess capacity to recessionary levels, commercial and industrial, C&I loans in recession. You have credit spreads between triple B and double B, causing a canary in the coal mine effect for a credit cycle decline. You have an inverted yield curve that occurred. High government debt, which is the number one reason. Right. You had an overvalued stock market, and you had extreme optimism. The readings that you have in the Fear Greed Index was at 97 on January 3rd. Today, it's back to 9, Fear Greed. So extreme fear.
So Corona is just a part of that, right?
Yeah. Listen, these are all things. When we were calling for lower rates, you have to look at everything in total. So all coronavirus did was the straw that kind of tipped this, but it was happening anyway.
I got to give you credit, too, because you mentioned this back in August, our last show. I went back and watched it. It was a half hour long, and we got deep. And you said, we're going to have the lowest rates ever. And I'm a big Barry believer, and that had me like, wow, really? And we're basically there. You also said, you called the 10-year, and I think what you called on our show just happened this week, which was, I wrote down the quote. It says, I promise you will be beneath the 137 level. I think we hit that this week, and we're going lower. You even talked about a 1% on the 10-year. Yesterday or today, whenever the show with Brian aired, you made two crazy predictions, too, that I actually really liked. You said, we're not going to ever see rates over 6%. Really interesting quote. And then you said, we'll probably see rates in the 2%. So
definitely will be you'll definitely be quoting a mortgage with a 2 in front of it, 100%.
Yeah, that's so. I mean, not that I normally do this in the show, but if I don't know how originators are doing their job without being a subscriber to MBS Highway. I mean, you've talked about this for a really long time, and I'm a conservative guy, especially when I'm managing other people's money. I don't like to take those risks, and so watching and listening to you, you help kind of refine my position of being overly, cautious, because it's easy to say, hey, the rates have dropped, take it. And it's hard to say, is it going to, I mean, these are crazy times. We haven't lived through this time. So to say it's going to get even better is really difficult for a traditional conservative person to say. So it's really helpful. Again, if you guys aren't subscribed, I don't know how you do your job without this information, without this intel coming out every morning.
Thank you, brother. Thank you. And here's the thing. We have all of our corporate accounts, which represent over 80% of our business. They're all like thrilled with us and thanking us because their pricing exceptions have gone down dramatically because people are not locking, and then 2 weeks later, you either have a pissed off client that you're going to lose, or then wind up writing a loan at a huge loss. And then guess what? You go through all that, and then rates drop again, and you got to go through the whole thing again. And look, I know all the other copycats out there. I know what they're doing. I know yesterday all of them said lock. Okay, we were the only ones who did, because look, they don't understand the market. They're being robotic. They're guessing. Okay, you don't need somebody who guesses. You need somebody who can explain to you what's going on. And even in the Fed is pathetic. Okay, let's just say it like it is. Pathetic. We had Warsh on today on CNBC watching him, and this guy thinks that the answer to all this is a quarter-point cut in the Fed funds rate. And first of all, these idiots, they squandered 3 rate cuts last year that they could have used when you had a real problem. Why? To prop up the stock market. I mean, they're like addicts. They're like junkies. They really are. They don't want to come down off the high, so they keep buying more stuff, okay? And what we really need is the Fed to get their head screwed on straight, stop with the hubris, and say, a quarter-point rate cut, that's like trying to fix a flat tire with a chocolate bar, okay? Yep. Will not fix the flat tire. It might make you happy for a minute, nom, 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 nom. Then it's gone, and now you got the sugar high, and you're going to come down from it, and you're going to be even more upset and more pissed, and this is what the Fed keeps doing to the U.S. public. This is the reason why you have income disparity. This is the reason why you have all of these issues in the U.S. Much of it stems from the Fed. And what the Fed has done has been absolutely horrific to the public, and they continue to do it. But Lacey Hunt is one of my idols, and he showed like all of the problems that we've had. And the one time that the U.S. got out of it the most rapidly was when the Fed did nothing. Every time, in every government around the world, he shows it. What the central bank does is elongates the problem, prolongs the problem, and endures much, much more suffering. You keep getting chocolate bars, you keep getting sugar rushes in between, but it's ephemeral. And really, is a quarter point going to solve the coronavirus? Is that, okay, we got a quarter point rate cut, I'm going to go back out to dinners? I mean,
no,
really?
Not at all. Yeah, you're right. When you understand the problem, is a quarter point going to allow me to go out and buy dinner or go to a public gathering or buy a car? You mentioned on Brian's show that China sales are down 92%. A quarter point doesn't help that. And so they obviously, to your point, don't understand the severity of the problem.
They don't get it. Why? Because none of them have even so much as had a lemonade stand or newspaper out. They've never been in the real world.
I love that.
And because they've never been in the real world, they don't understand how the real world works.
Yep.
So if your only tool is a hammer, everything looks like a nail to you.
Exactly. Let's get out of our typical lane and kind of talk to consumers and realtors a little bit. What should we do, the average person? Like, do we panic and pull our money out of our 401ks?
Well, I tell you what, I'm going to tell you a level on the S&P 500. I think it's 2350 is a pretty good level on the S&P 500, but nobody knows at this point in time. I think that seems like a very, very long way off for here. But when I started talking about the 200-day moving average to our subscribers, and you know this, when the S&P was at 3,300, I'm starting to talk about, 3,000, 2,900 as the levels that we were looking at. Everybody thought we were nuts. We got there in less than a week. Okay. So I don't know if it takes 5 days to get down to these levels that look to me like really strong support, but it's quite possible. So strategies for this is, yes, to some degree, the cat's out of the bag. The horse has left the barn, whatever metaphor you want to use. But I still think there's room to the downside. Now, if you're like a little bit of a deer in the headlights, one thing you could do is you could purchase some puts. They're not very expensive. As prices on the stock market, if they continue to go down, it protects the assets that you're having, and you'll make the money you lose will be made up by the money you gain on your puts. It doesn't cost a lot of money to do so, and if your asset values rise because this thing bounces, somebody comes up with a cure, with a vaccination, and all of a sudden the stock market begins to rally and confidence returns. Okay, you lost your money on your puts, but you're feeling a lot better about your portfolio. So that's probably a good approach. I started lightening up, and I was very public about this, saying I lightened up on stocks. I was early, but I was putting in the bond market, so I made a lot more money in the bond market on the longer end than I even by being early in stocks. So that was a good approach, a good tactic. I talked about that even from the stage many times last year, even at Mastermind, I talked about that. But at this particular point in time, eventually this thing will pass. Okay, so we're going to be okay. If you don't need to take your money out of the stock market for a couple of years, don't worry about this. If you need money to buy a home or you're going to be using it, you probably should either buy some puts at this level to protect yourself on the downside, or maybe think about making some investment into the bond market here, because I do think yields go lower.
Yeah. One of the strategies, phrases you taught me 15 years ago is buy when there's blood in the streets. I think it's Baron Rothschild. And I don't know that we're there yet, but I agree that it's probably going to get worse before we get better. Is there going to be opportunity? Because it seems like you've talked a bit about this recently, that housing's still strong. You called it a trifecta. I think you said, housing's strong, rates are low, and I can't remember the third one.
And you have equity, and people have equity in their homes.
So I don't know that there's necessarily blood in the streets, but I'm trying to phrase a question for realtors, like how do they handle this?
You want to look for capitulation, and we have not seen capitulation yet. We have not. Are we getting closer? We're getting closer. But capitulation is where everybody is scared and throws in the towel. We're not there yet. Right now, people are aware, they're worried, they're concerned, and they're questioning what I should do. It's the point in time when people look at their statement and they say, I can't take this anymore. I give up. I just have to get out. I can't take it anymore. That begins capitulation, and you have something that's called a climax sale. We've not seen a climax sale yet. You know what a climax sale is? Back in 1987, when the stock market dropped to levels where people that was a bottom, okay? In 2009, in March of 2009, that was a bottom when you just saw the S&P go to 666. It was just a climax sale. As bad as these numbers look on a percentage basis, because the market is so high, we're not seeing that, 8% in one day, or 7%, or like in 1987,
I don't even know
22.
that we're building up to that climax sell yet. I mean, I guess it could if it compounds and it gets worse. I guess we could start to see that. But am I wrong? Are we?
Outbreak in the U.S. will cause that, in my opinion.
Okay.
And I think there's a high probability that will happen.
What does that look like if we see that? I mean, another bold prediction. Is it months away? Is it weeks away?
I think that the way that this virus is spreading, I think that we will begin to see that as soon as you can test for it, in my humble opinion. I think when you can test for it, you'll start to see that it probably has a chance of already being here. How do you contain it?
Well, I'm sure it is,
all over the world. How do you contain it? I mean, and think about this. Now, I just had Ivy Zellman, one of the smartest people in the world. She's asking me, she says, Barry, I'm supposed to go to France. We both have the same doc. Dr. Roy says he wouldn't go. So would you go? And, once you start to have that play in your mind, where does it end? Yeah. Where does that stop? When really smart, rational people start really thinking about, is it worth it for me to do these things? All the elective ends of the business will probably see a bit of a slowdown.
All those things add up, like you talked about, not traveling, not buying cars, not going to the moon. All of that adds up. And I'm going to Cabo in 2 days, and I'm thinking about it. I researched it. Right now, there's no cases in Mexico, but Well,
no, there's a case in Mexico this morning.
I did read that, but when I researched it 2 days ago, there wasn't. But I don't know if they're not reporting it. Are they testing for it? I don't know. We're still going, but if,
and
to
I
your
would
point,
go
it forces
too.
you to ask that question. Like, should I not spend
I would go too,
the tens of thousands of dollars?
Yeah, but you contemplate it, right?
Mm-hmm.
I mean, and that's all you need is the doubt. Now, you're going because you already made the commitment to go, and so it's a decision. But think about it this way, right? If you hadn't already made the decision to do so, would it be even easier for you to postpone it?
Well, yeah, and it's a great time to be, as you've said this week, you need to be working your ass off. So I shouldn't be in Cabo. It's a company trip, so I got to go. But I 100% agree with you. I sent a video out to my team, like, guys, this is the time to work. To your point the other day, you said this is not the time to golf. This is long hours, long days. I was sitting next to an originator yesterday that put $10 million in loans just from being on the phones in one day.
And that's exactly what you should be doing. I mean, this is your time. This is the time for you to do this. This is an incredible opportunity. And there's something else at play here. It's a tiny bit deep, but if I'm going to try and break it down easy for you, and it's called convexity buying. So convexity is an interesting phenomenon that occurs. And if you're just for a minute here, just focus and stay with me, is imagine you're a bond fund manager. And as a bond fund manager now, what you have to do is you have to disclose. You have to tell your investors what you're going to invest in. You can't just say, hey, give me my money, whatever I feel like, I'll put it. Can't do that, okay? So if you're going to invest in the bond market and you say, well, the duration that I'm going to target is intermediate duration, 4 years to 8 years, something like that, 4 to 7 years. Well, why do you have to do that? Because if it's shorter duration, there is much less price volatility. Longer the duration, the longer you're out there, the more susceptible you are to inflationary changes, to changing credit quality. So, it's a lot risky. Put it this way, it's a lot riskier to have your money at risk for 30 years than for 6 months. We can understand that, right? So you have to disclose to your investors what it's going to be. So if you say it's intermediate term, well, mortgages typically stay on the books for 4 years, 5 years, whatever it is. That's common, right? But not right now. What's happening right now? Rates dropped. So what's happening to that guy who just wrote $10 million in a day, or everybody who's listening that's writing all these refinances? The duration is shrinking.
Yeah.
So because the duration is shrinking, now if you're that fund manager, you're out of guidelines. So you're saying, wait a minute, my duration has shrunk from 4 to 7 years to 2.5 years, maybe. So how do you fix that? There's only one way. You buy the longer side of the curve. You buy 10-year treasuries. Why do you buy treasuries? Because the government's not going to refi it when rates drop. That's going to be out there for 10 years. So that now elongates the duration on your weight, right? Your weighted duration is now back to where it should be. But what does that do? That means all your money went into treasuries, which what does that do to treasury prices and yields? Well, the price gets bid up and the yield, like you're seeing, gets pushed lower. Now, when the yield on the 10-year treasury goes this far down, mortgage rates lag because all the money went into there. But what pushes mortgage rates lower from there is other fund managers who have different durations or are just looking to invest say, I can invest in treasuries. The yield's down here. Mortgage bonds, the yield's up here. On a relative basis, I'm buying mortgage bonds. And as they buy mortgage bonds, it bids the price up, brings the yield down,
Jeez, yeah.
which triggers more refinancing, which causes more convexity buying, which then brings, so this is where we are right now.
Yeah.
And it stops when the stock market starts to recover and money comes out of the bond market. That's when it stops. But this, I don't see stopping for a little bit. That's why I'm saying 1% on the 10-year treasury, to me, is going to happen. 2% as your lead number on mortgages is going to happen.
I was just going to ask you, is that when lenders and realtors, because I know realtors watch and listen, smart ones do, is that when you're going to change your stance to a locking basis? Because you talked about how, sure, there's ups and downs, in the analogy you use as a kid with a yo-yo on an escalator. Great analogy. But for the average person, what should we be watching for this reversal, this trend reversal? Is it as simple as, hey, when the Dow starts to recover, they're going to pull out, money out of stocks, and
when the stock market makes a recovery on fundamentals, not on dead cat bounces, when you see some real news that appears to either stem the tide of the coronavirus, stem the spread, hope for a vaccination. Well, it's not a cure, but it will stem the spread. These are the types of things that will encourage the stock market, not an ephemeral rate cut by the Fed, which would just be stupid.
Right.
And you'll get a 1,000-point bounce in the Dow, and then it'll just whittle away, and before you know it, the downtrend continues, and it'll be just another waste of a potential use of a tool by the Fed because they squander it again, like they always do. So what we want to do here is see for a real sea change, and then when you get that stop in convexity buying, then we have to be careful, because from these very low levels that we're refinancing people, you now will see, if rates eventually do turn the corner and start to move up, you'll get the reverse. You'll get convexity selling. What does that mean? So now, if you've got a mortgage at 2 3/4, your chance of refinancing that rapidly, or even moving from there because it's so attractive, becomes more diminished, and you're going to get greater duration. Now your duration's too long. How do you lighten it up? You sell 10-year treasuries.
Yep.
And you sell those 10-year treasuries, 10-year yields go up, and that eventually pulls mortgage yields back. So we're not anywhere near there just quite yet, but we have to be vigilant. We have to watch what's going on. I think that the debt levels in the U.S. are very repressive towards rates. And I think, like, even if you go to the election, whoever wins will increase debt. If a Democrat wins, you'll have higher debt. If a Republican wins, you'll have higher debt. And that will be repressive towards rates. So I think we're in a good position. I think real estate is going to be the beneficiary. Demographics are wonderful. And while almost everybody was talking about the real estate being bad and this and that, and but I've been very steadfast and very bullish, and pretty much the only voice out there that has been so bullish on real estate. All those fundamentals still in place. You're going to see great appreciation in real estate in years to come.
Yeah, we'll close with one last question for realtors. Speaking of real estate, bold prediction or advice, because in my market, I don't know about yours, I'm on the opposite side on the West Coast, but I only have 0.4 months worth of inventory, which is insane. 0.4. And so I don't know. I mean, people are staying in their houses longer because they have, cheap money. What do realtors do? I mean, we just don't have enough to sell anymore. So I'm not sure, what the advice would be, because you can't just manufacture new homes, especially in Seattle, because there's no more land. In other states, I can see new construction doing very, very well for the foreseeable future. But in my hometown and where you live, there's no new land. So I'm not sure what realtors should be doing right now.
Yeah, I split my time between Jersey and Florida, but I travel all over and I get to talk to people, and we monitor every zip code in the United States. So here's the thing, and you're so right, Ryan. You always nail it. You always have such a great understanding of this stuff, and you're right. It becomes a fundamental issue. There is simply more demand than there is supply. And when you look at demographics and birth rates, it's so funny. What am I looking at? I'm looking at birth rates. That's what I'm looking at. Okay, so these are the types of things that we look at to try and see the future before it becomes obvious. So as we look at these things, it is very crystal clear to me that the demand supply issue will remain challenging. You will have, in most markets in the US, more demand than supply. And as with anything, that will push prices higher. Now, remember this, that anything can be sold for a price. So there's no inventory until you start bidding people's prices up, and then they say, okay, at that price, I'll sell. Eventually, there comes a price where somebody will sell. So the demand, as it becomes greater, remember, rents are still going up 3.8% per year. As that demand becomes greater, what you will eventually see is that you'll free up the inventory by bidding it up in price. And that's why I'm so bullish on appreciation. And that's why if you're a realtor, this is what you have to tell your customer. Don't choke yourself and don't, go crazy, but you have to reach higher. If to the extent that you're qualified, bid a little bit more. Get the home you wanted, because then you'll gain that appreciation yourself instead of missing it. And look, we all know this. We all know this as realtors and mortgage professionals. People oftentimes can qualify for more, but they internally just feel a bit uncomfortable. And under normal circumstances, I would never challenge that, because you want the person to feel comfortable. However, this is the advice we've been giving. I've been saying this for a long time. It's the reason I said, don't pay points, try to exchange rate for closing costs, don't pay upfront MI. You've heard me say that for a year, right? So to the extent that you want that home and you really want it, go a little bit out of your comfort zone, because here's what's going to happen. You'll get the home you want today. You'll get the appreciation and the amortization, and the payment that you desired, you'll have that in the near future. Because as rates come down, you'll refinance and already own the home of your dreams with the payment you desired. So you can have your cake and eat it too. Don't be afraid to go a little bit higher. And that's if you're a realtor listening or a mortgage professional. Again, don't get crazy with it, but to the extent that they're qualified, they can handle it, but they're just a bit uncomfortable, push the envelope a little bit, because they'll get the payment that they're comfortable with eventually.
Yeah, and I agree with that, which I normally wouldn't, because I lived through the Great Recession like you, and I saw what happened to our industry and people being over leveraged, but you can't even get in the game right now, especially in my market. So I agree with what you're saying. And you said the devil's in the details, to your comfort level. We're not asking you to go crazy. Get yourself maybe just a little bit outside that. Make sure you can still pay your bills. We've already learned that lesson, right?
Yeah.
And again, we're not doing stated. We're not doing, interest only. We're talking about a 30-year or 15-year fixed principal and interest.
Hey, look, for most people buying a home for I don't know, for $300,000, $400,000, $500,000, $600,000 in your neck of the woods in King and Pierce County, it's greater than that, right? $800,000 is the median home price in King County there. So when you take a look at this stuff and you say, could that buyer afford $150 a month more in payment? Could they?
Yeah.
Probably. $150 a month, if it fell out of their pocket, they probably wouldn't feel it that bad. You can always find $150 at that level.
Yeah.
Well, that comes out to somewhere in the neighborhood of $30,000, right?
Yeah.
That's how crazy it's gotten.
Yep.
So $30,000 may be the difference of you getting that home you wanted.
Exactly.
And not, without putting yourself in a position where I'm in dire straits for $150 if I'm an $800,000 buyer. You get what I'm saying?
And it's relative. To cheap money, best part,
It's relative. It's relative.
Yep.
So, and by the way, from 2 weeks ago, you already saved $60 or $70 on that payment anyway.
Yep.
So you're not really extending yourself that much.
Yep.
You're extending yourself a tiny bit. You're extending yourself a couple of trips to Starbucks for the home of your dreams. And guess what? In a few months from now or a year from now, when the recession eventually happens, or even before that, you're going to have that payment you wanted anyway. Yeah. So you got the best of both worlds.
Yeah, love it. Hey, I'm going to close with this. I'll say this for you, Barry, because we have I love our audience. It's growing. We have entrepreneurs now watching. We have a lot of C-suite people that watch too. So if you don't have an enterprise relationship with MBS Highway, I would definitely take a look at that. You gave the best commercial ever for why you'd have an enterprise relationship with it, which is pricing exceptions. I'm sure the amount of pricing exceptions that your intel saves a company pays for the enterprise relationship itself. If your company doesn't have one, though, first of all, push on it. Second of all, get your own subscription, because it's more than worth it. And so I'll say that for Barry. I genuinely believe that. I don't know how we're doing our jobs without this intel. You come out every morning and give us very clear advice as what to do. You're winning awards for the predictions you're making. So I'll say that for you, and I really appreciate your time, man.
Thanks, buddy. Well, love you. Love what you do. Love what you do for our industry. I know you mentioned our dear friends, Frank and Brian at the National. What would our industry do without you guys? I mean, really, without the three of you guys, we would be far less informed if it weren't for what the three of you guys are doing out there. And I appreciate you. I watch you guys all the time.
I appreciate it. I know you text me out of the blue and I'm like, oh crap, he's watching. I didn't know he was watching.
I watch you all the time. Yeah. I watch you and Frank and Brian. I watch it because it's important. How could you not? Yeah. It's the old saying, if you want something done, give it to a busy person. It's just having disciplines to do the right things every day that make you more valuable to your public. So what I learned from you, makes me more valuable.
I appreciate it. I'm proud of it, man. We've been doing this 10 years now, over a decade. And so I appreciate the time that you spend and all the knowledge that you share with us. And I know you're a busy guy, so thanks for carving out. I don't even know how long we went, half hour. I really appreciate it. Guys, check out MBS Highway. We'll put a link in the comment section below. And Barry's super nice. You know, he's the busiest guy I know, but I'm sure he'll answer questions if you want to throw him in the chat log below and tag him, because we covered a lot. And if you're a consumer, you might not be able to distill it all down. Throw questions at both of us, and we'll try to answer them. We'll see you guys next week.